Start, sir.
Good afternoon. So welcome to the live session on the management of commercial banking. So today what we will be discussing about the certain kind of doubts or clarifications, whatever you have, or you have any specific questions related to any particular topic, whatever we have discussed. And as well as we'll be discussing about the overview of that particular course, what we have discussed within that 12-week sessions, where this you have these all those materials, and as well as the recording materials and PPTs which are available to you. So before that, we have certain questions what you have sent. Let me ask you that question, then we can go ahead with the other questions and as well as the overview of that particular subject. So one question I've received that what bank should I choose as job in banking? So if you remember that whenever you talk about the subject only deals with the particular type of bank, that is the commercial bank. So if you look at the current scenario which is happening in India, we have three types of the banks which are operating. One is public sector bank, one is private sector bank, and another one is the foreign banks. Foreign banks are basically working as a kind of subsidiary to the Indian banking sector. Maybe the parent company is existing somewhere else, and these banks are basically working on behalf of that parent company, which is existing in other country. And we talk about the private banks like your HDFC, ICICI, Axis Bank, who are also doing well. And reasonably, we cannot say that they are privately held banks, or maybe we can say that the companies have if you look at the ownership of these particular banking companies, we have a lot of public shareholdings which is existing in these particular banks also. And we have the public sector bank, which is mostly owned by the governments. And why we call it is owned by the government? Because the majority of the shareholding is from the government only. So the banking sector always works with efficiency. So wherever bank you want to join, there is no differences in terms of the activities or we can say that nature of the job. So any bank will be better if you talk about the commercial banking part. So obviously people have the apprehension to join in the public sector bank. They feel that the nature of the job is secured and there is a security in terms of the job and all these things, but it is not the case that we have to think. So any bank, whether public sector, private sector, no differences in terms of the nature of the job and the activities what the banks carry out. Another question, what is the impact on job and money security of the privatization of the banking sector? There is no such problem unless the financial condition of that particular bank is good. And another advantage also we can say that in the context of privatization, the efficiency of the banking sector also can go up, because the bank is answerable to many stakeholders who are the major stakeholder of the company. And in that due process, the governance system of the bank also will be stronger. So the fraud and all these things, what we are always thinking whenever we keep our money in the banking sector, we always think that our money is more safe whenever we have the public sector bank, but it is not the case, provided the particular bank's financial condition is quite strong and there is no such kind of liquidation problem, or the bank is suffering from any kind of specific issue. So if that particular bank is suffering from specific issue, whether it is public sector and private sector, obviously there are certain concerns, there are certain issues we have to keep in the mind. But unless that kind of issue is not there, and the bank is working with full system, with full efficiency, and as well as the operating performance of the company is good or the bank is good, in that sense, it will not have the much impact on the security of your money, whatever you are keeping within this banking sector. But sometimes also you'll find that if you are going by the larger banks, then the probability of failure is relatively less. But if you go by the smaller banks, then there is a probability of the failure. Maybe the the probability of the failure is relatively high, but in that particular context also you have to keep in the mind these banks are highly regulated. So RBI has always has a close eye on this particular performance or operating activities of this particular bank. So in the short run, we may face some problem, but that problem can be resolved within a short span of time due to the proper intervention of the central bank authorities. In the context of India, we can say this is the Reserve Bank of India. Okay, so these are the two questions up to now, whatever we have received. So let me tell you that whenever we talk about the banking sector, you see that if you have read this kind of all those kind of materials which are available with respect to the management of commercial banking. So in the first part, we started the discussion with the role of the banks in the economic growth process. Because already all of you know that there are two types of systems always we look at. One is your bank-based system, other one is the market-based system. And if you talk about India, the India is basically a bank-based economy. Our payment gateway, all kind of transactions and all kind of financial transaction process which is happening. These are things, all the things are happening through the commercial banking only. Commercial banks are responsible for all type of transactions. So our reliance on banking sector is quite large. So that's why we consider we have a bank-based economy. So bank-based economy is relatively conservative in nature, because sometimes any risky kind of process or any kind of technology which is new, so in those kind of business may not be financed by the banking sector. But if you look at the other activities from the social perspective, always the bank-based economy always does better than the market-based economy. So after discussing about the significance or the importance of the bank, we also discussed about the banks, why the banks are so special among the different other financial intermediaries. In that process, what we have seen that the banking sector is really has a significant difference across the different kind of financial services industry because of economies of scale and economies of scope and better monitoring capacity. Because of their existence and as well as the better monitoring capacity, commercial banks always play the major role or maybe significant role in comparison to the other kind of financial services companies which are existing in the financial system. And afterwards, we started the discussion on the why the banks are regulated. Obviously, the banks are regulated because bank is the backbone of the financial system. And already we have discussed that the bank is the payment gateway of all type of transactions across the markets, whether it is money market or stock market or foreign exchange market or any other market. So because of that, the banks should be regulated to avoid this failure or any kind of market failure if that happens, or any kind of things happens across the globe. So that things should be controlled through the regulations or through the government interventions. So that's why the banks regulations are very much important. So there are certain norms what this Indian commercial banks also follow, like your KYC norms, like your different kind of act, whatever we have about the Money Laundering Act, then all these things already you might have the idea about that. Those things are very much important whenever you talk about the regulations of the commercial banks in India. And as well as for better transparency, RBI is always is very much monitoring these particular activities. By that, the banks can always run in a very effective and sustainable way. So after this regulations part, we started the discussion about the bank's financial performance or maybe the different financial statements of the commercial bank. So there we broadly discussed about the two types of statements. We discussed about the balance sheet and as well as we discussed about the profit loss account. So all of you know that the balance sheet contains the different assets and liabilities, and the major assets of the commercial banks are basically the loans and this investment activities, and as well as some other assets like fixed assets and the other intangible assets and all. But the major component of the assets basically include the your investments and the lending activities or the bank loans. And whenever we talk about the liability side, the major liability of the commercial banks are basically the deposits. But apart from this, you can also observe why the banks are different among, or the objective of the bank is different in comparison to the other companies which are existing in the system. Because other companies, the basic objective is to maximize the profitability, but the bank's objective is not only to maximize the profitability, their objective is also to maintain the liquidity. So maintenance of the liquidity also is quite very important from the banking perspective, because they want to fulfill the day-to-day requirements of their existing customers. And we have a fractional reserve system in the commercial banking sector. Certain money has to be deposited as per the legal requirements like your CRR, cash reserve ratio. And certain money has to be always kept with the bank to fulfill this liquidity requirements of the customers. And the rest of the money can be utilized for the lending activities. So in that particular process, always we look at the asset and liability management in a proper way. By that, any kind of fluctuations in the market with respect to the change in interest rate and other kind of market risk, that can be really managed by the commercial banks. Then in that particular process, we have linked it to the asset liability management. So what the asset liability management is basically all about, the asset liability management basically explains that how the assets and liabilities should be managed, or how the asset and liability component or structure should be made. By that, the interest rate fluctuations in the market will have less impact on the value of the assets and liabilities. So in that process, in other words, we can say the asset liability management's objective is to minimize the interest rate risk in the market. So therefore, there are different kind of asset liability management or ALM techniques we have discussed. We discussed like your gap analysis. We discussed about the durations. We discussed about the duration gap. Then we also discussed about certain kind of activities with respect to how the assets can be changed or how the liability can be changed depending upon the movement of the interest rate. If the interest rate is going to increase, then your bank should be asset sensitive or the bank should be liability sensitive. And the asset sensitiveness and liability sensitiveness will always measured through the maturity period of that particular asset. So in the different maturity buckets, we want to explain that what is the planning horizon and what is the period. And accordingly, we have to maintain or we have to make our strategy. By that, any fluctuations in the interest rate risk should have less impact on this. And before that also, we discussed something about the valuation of the different kind of assets what the banks have, like your valuation of equity, valuation of the different type of bond instruments. So in that context, we discussed about the different type of yield, and as well as the valuation of equity, different models. Then within the valuation of the equity, we have discussed about the discount flow models, and this another is the relative valuation techniques like your price earning ratio, price to book ratio, price to sales ratio, and all these things, which is better used for investment purpose, that which particular asset or which particular stock should be considered for the investment depending upon the different kind of multipliers like your price earning and price to book ratio. Then also we discussed about the dividend discount model and all. There already all of you know that we are going to calculate the intrinsic value of the asset. So in that process, we always look for a good discount rate. What is the appropriate discount rate? And what is the cash flow we have to consider, which is the dividend here. And also we can consider the free cash flow to the equity or maybe the operating cash flow. These are also can be considered as the cash flow. So on the basis of the cash flow, your discount rate also can be changed. Your discount rate can be cost of equity, or it can be also the cost of capital. So whenever you talk about the cost, dividend is the cash flow, we use cost of equity as the discount rate. And whenever you go for your operating cash flow as the cash flow, then we use the cost of capital as the discount rate for that particular case. So then we discussed about certain yield concept that already you told, yield to maturity, then your current yield, then you have the duration, then you have the convexity, all type of concepts we have discussed before we go for ALM. And in the ALM process, already I told you, basically we discussed about the gap analysis and duration gap analysis, and as well as how the bank can restructure their assets and liabilities to manage the interest rate risk. So there is a relationship between the dollar gap and this interest rate. So if there is a positive dollar gap, that means the dollar gap is nothing but the interest sensitive assets minus interest sensitive liabilities. If there is a positive dollar gap, then there is a positive change in the interest rate, or interest rate is going upward, then the bank's net earnings or net interest margin will be enhanced or will be increasing. So if there is a negative dollar gap, then if the interest rate is declining, then it is also profitable for the banks, because in the net interest margin is going to be increased. So therefore, depending upon the interest rate movements, the banks want to maintain either a positive dollar gap or they want to maintain a negative dollar gap. But in the context of duration gap, the basic objective of the duration gap is to link your duration gap with the net worth of the bank. It is not the net interest margin. This dollar gap does not talk about the what we can say that net interest margin, and the dollar gap talks about net interest margin, but that does not talk about the net worth. It does not lead to have a relationship with the net worth, but duration gap basically establishes the relationship with the net worth. So if there is a positive duration gap, then if there is a interest rate will increase, then it is net worth will decline. So it is an inverse relationship. So whatever relationship we have expected in terms of the dollar gap, the relationship in terms of the duration gap is different. So if the interest rate will be declining, then if you are maintaining a positive dollar gap, it is good for the bank. So if your interest rate is increasing, if you are maintaining a negative dollar gap, then it is good for the commercial banks, because their net worth is going to be enhanced, or change in the net worth is going to be enhanced in that particular process. In that due process, what happens, the banks can follow two types of strategy. One is defensive strategy, another one is the aggressive strategy. So the defensive strategy means basically they want to always make their gap equal to zero, whether it duration gap equal to zero or the dollar gap equal to zero. So if they can maintain their gap zero, then any change in the direction of the interest rate is not going to affect either their net worth or their net interest margin. Those things are basically net interest income is not going to be affected by that. But if they will go for an aggressive strategy, so in that particular process, they always want to make their dollar gap either positive or negative, depending upon the movement of the interest rate. So that's why there are different kind of strategy, there are different kind of approach to restructure their assets or to restructure their liabilities. So they will restructure their assets and liabilities. That means they will manage either the asset side or they will manage the liability side to enhance their net worth and as well as the net interest income of that particular bank. So this is about the overview of the ALM, or the asset liability management of the commercial banks. Then after the discussion on the asset liability management overview, we have tried to discuss about the typical asset management or typical liability management. So in the asset management part, there are two items which are the major items. Also we also discussed about the different kind of derivatives instruments, how these derivatives instruments are used for asset liability management process. So we have the options, we have the futures, we have the swaps. So we discussed certain kind of methods, certain kind of strategy by which this kind of instruments can be used to manage the risk in the market. So in that process also, the asset liability management of the commercial banks can be done through this kind of instruments which are available in the system, like your futures, options, and swaps. Then after that, we have moved towards the actual specific kind of assets and specific kind of liabilities. So the specific kind of assets and specific kind of liabilities means, already I told you, there are two major assets the commercial banks have in terms of the percentage. If you see, one is your lending activities, then other one is the we have the investment activities. So in the lending activities, we have there are many issues we have discussed in that case. First of all, we are trying to examine what are the different types of lending activities the commercial banks always carry out. In terms of lending activities, the loans, basically what the commercial banks give, they're categorized into various ways. And the broad category is the loans can be given to the commercial sector or the industrial sector, or the loans also can be given to the retail sector or to the consumers. So in that case, before they go for the loan, the commercial banks make a loan policy. The commercial banks will have a loan policy. Then in accordance with that loan policy, they try to always evaluate this loan demand, which is coming from the different kind of clients. So in the loan policy part, the first of all, basically what they do, they go for a thorough assessment of the different parameters of that particular client. For example, let us start with the discussion of the business loans. So whenever you talk about the business loan, first thing basically commercial banks try to examine about the all those financial aspects or financial ratios of that particular kind of company to whom basically they were trying to give the loan, or this particular company has asked for certain loan to them. So in that particular process, they go for the financial leverage, they go for the profitability analysis, they go for asset utilization. There are different ratios basically they analyze, and they try to find out the potential or the credit worthiness of that particular kind of company or particular kind of client. Then after that, through that particular process, they try to measure the ability to pay, because there are two approaches of the lending, always you keep in the mind. One is ability to pay, and another one is the willingness to pay. So it is difficult to measure the willingness to pay, but it is easy to, or maybe to some extent it is possible to calculate the ability to pay. The ability to pay basically always try to examine the future expected cash flow what that particular entity is able to generate. So in that particular process, they assess that particular loan and provide the loan to them. And another thing that in the lending process also, there are lending approaches what I was talking about. One is your liquidation approach. Another one is the, we have the going concern approach. Liquidation approach means whenever the banks gives a loan, they basically take some collateral against that. If at any point of time you are a defaulter or the loan will not be repaid back, then the bank can liquidate those assets and get back that particular money, whatever money you have not repaid to them. And in that particular process, they keep certain margin. What is that margin is basically, the margin is the value of this particular asset. There is a difference in terms of the value of the asset and the loan basically what the bank has ready to provide you. That means the value of the asset is always more than the loan basically what they sanction against that particular asset. Because there is a fluctuations in terms of the value of the assets, but that margin amount vary across the different types or different nature of that particular assets what you are providing. The margin is relatively less whenever the asset is like immovable asset like land and all these things. So the margin is relatively higher if you are using the financial instruments like equity or bonds or as the collateral. So gold, so all kinds of vary from asset to asset, the nature on the basis of the nature of the asset, the particular kind of margin amount always varies or margin percentage always varies. So that is basically in that particular process, banks basically follow the liquidation approach. But whenever you go for the going concern approach, bank does not basically consider the what is the asset which can be used as a collateral and what is the value of that collateral and other things. What do the banks look at? The banks basically look at your how much future cash flow this particular entity can generate. The expected future cash flow basically is a major concern for them. So if you are able to, or your balance sheet basically is showing that you are able to generate that much amount of money or that much amount of profit, which will be enable them to provide this repayment against that particular loan, then they will be ready to basically provide that particular kind of loans to them. So this is the way basically the lending activities, the margin things and all these things basically works out in the banking sector in terms of the business loan. Then the another concern here is the loan pricing. How this basically banks go for the loan pricing. Then whenever they go for the loan pricing, they go for the different models. Then cost plus loan pricing. That means how much cost the bank is bearing for this loan. And against that, they add two, three different kind of premiums or the margins. What are those premiums? One is your risk premium. Another one is premium with respect to the maturity, because the longer term loans are always riskier than the short term loans. So because of that, one is your default risk premium. Another one is the risk with respect to the long term and short term. Then another one is the profit margin. So all these things has to be considered. And there is a base rate against that particular loan. The base rate can be a marginal MCLR, marginal cost of lending rates, or it can be a base rate which can be fixed by the bank, and which is the minimum rate at which banks basically provide the loan to the different customers. Then also they go for the other kind of loan pricing models, like they can go for the customer profitability analysis and other type of analysis for the loan pricing also. So in that due process, the major part of the lending activities can be covered up, or the management of lending activities can be covered up. Then we can move towards the investment activities. The investment activities means how the banks basically invest in the different assets. And the assets are basically categorized into two. One is your short-term asset, another is long-term assets. And the basic objective of investment in the short-term assets basically is to fulfill the requirement of the liquidity part. Like they generally prefer to invest in the money market instruments, like your government treasury bill, certificate of deposits and other things, or the repo operations and all. And whenever they go for the long-term assets, they can go for the government dated bonds, or they can also invest in terms of equity and other kind of assets which are available in the market. So in that particular process, the major thing is basically the strategy. What kind of strategy the banks adopt? The strategy, whenever the banks adopt, the strategies basically can be broadly divided by two parts. One is your defensive or the passive strategy. Other one is the active strategy. And the basic objective of the passive strategy is to what? The passive strategy objective is not to beat the market. It is the passive strategy is basically to get the return what the market is giving. And here the basic objective is to minimize the risk, not to maximize the return. So in that particular process, there are various strategies basically they can adopt. So in terms of the bond investments, the strategy can be, they can adopt a buy and hold strategy. It is also applicable for investment in equity. They can go for a strategy called the bond laddering strategy. So that means they can invest the equal amount of money in the different maturity buckets of that particular kind of asset. By that, they can hedge out certain interest rate risk in the market. They can go for a barbell strategy. So these are the different kind of strategy what they will adopt whenever they go for the passive strategy. So in that process also, they can go for indexing strategy in terms of equity. Indexing means they will look for a benchmark index and they will invest only those stocks which are a part of that particular index. And also equal proportion, same proportion of money will be invested in that. And in that particular process, their basic objective is to minimize the tracking error. So what is tracking error? The tracking error is basically the variance of the deviation between your return, what you are experiencing from that particular index, and what the benchmark index or the market index is giving. So then you have your objective is basically to get the return what the market index is giving, or to minimize the return differences between these two, or variance of the return differences between these two. Then apart from this, they can also go for immunization strategy. And the immunization strategy basically works out whenever you want to minimize your interest rate risk. So if you want to go for immunization strategy, basically it is the matching strategy in terms of the duration. So that means your duration of assets should be equal to a duration of the liabilities. So if you are making your duration of assets is equal to duration of liabilities, then perfectly your total return or the total value of that particular portfolio is not going to be changed. So even if the interest rate will decline or interest rate will increase, your total expected return, what you are expecting to get from that particular investment, that will always remain same. So that is called the duration matching, or the asset duration of the asset should be equal to the duration of liability. So that is very popular strategy in terms of immunizing the interest rate risk in the market. Then apart from this, we can have some active strategy. So within the active strategy, the famous strategy is basically the expecting or predicting the interest rate, reading the yield curve. So these are the different kind of strategy what we adopt. And whenever we go for the yield curve basically is a predictor of the market movements or the trends of the market, like recessionary or deflationary trend. So in that particular process, we can decide whether the interest rate is going to be up or the interest rate is going to be down. Then accordingly, we can restructure our portfolio. By that, your return can be maximized in the market. So this is about basically your investment part. Then we can go for the, what are those other aspects? Other aspect is basically the major aspect of the liquidity. So whenever you talk about the liquidity, you keep in the mind that liquidity is basically very important from the banking perspective. Then how this liquidity is basically measured? The liquidity is basically nothing but the change in the deposits minus the change in the loans in a particular time period. So the banks always try to measure, basically it is either weekly basis or monthly basis. The money manager of the bank always try to measure the liquidity across the banks So there are sources and uses of the funds approach to measure the liquidity, where they can consider sources are basically what? The sources are basically the deposits and the uses are basically the loans. So then they will look at the what is the change in the deposits in a particular period and what is the change in the loans in a particular period. And if you take the difference between them, then that will give you basically the idea about the liquidity requirement of that particular bank. Then we have another approach called the structure of the fund approach. In the structure of the fund approach, basically what we do, we categorize the deposits. The deposits which are highly volatile. There are certain deposits which are vulnerable in nature, and there are certain deposits which are stable. So then we are talking about the three types of deposits. What we do, we give the different weights to the different deposits. So the different weight in this sense, whenever the liquidity requirement is measured, let 95% weight we are giving to the particular assets which are highly volatile. That means 100% probability or 95% probability that the asset will be withdrawn or the particular deposit can be withdrawn. And whenever you go for this vulnerable part, the vulnerable in the sense that maybe 25 to 30% of the total funds can be withdrawn. And in the last case, basically stable funds, there is less probability that the money will be withdrawn in that particular period of time. That is called the stable fund. Maybe the weight can be given up to 15%. So in that particular process, we calculate this particular kind of liquidity of the banks, and we call it the structure of the fund approach. Then we have a liquidity indicator approach. In the liquidity indicator approach, what we do, we use different ratios. We use different liquidity ratios, like your deposit to the loans. Then we have the current assets to the total assets. There are different ways that there are around a long list, whatever we have provided. So you can consider all those kind of ratios, which ratio basically provides that what is the liquidity position of this particular bank, whether the liquidity position of the bank is stable or not. Then accordingly, we can say that the bank is liquid or illiquid. Then another approach, we have also the market expectations or market forecasting approach. There we consider certain things with respect to public confidence, what the market perceives about the bank and all these things. That is also another way we can always guess that what kind of liquidity the bank has. So these are the major issues in terms of the liquidity, which is a major concern. Then whenever we talk about the liability side, in the liability side, the major part is the deposits. The deposits already you know that there are broadly two types of deposits the banks hold. One is your demand deposits, other one is the time deposits. Then within the demand deposits, we have the saving deposits and the current deposits. And within the time deposits, we have the fixed deposits and the recurring deposits. So the bank always have to see that how these particular deposits can be managed. By that, there should not be any kind of problem in terms of the gap, whatever we have in terms of the maturity of the deposits and the maturity of the loans. By that, the bank will not be in a position to face any kind of risk, and that particular thing is a major concern for the commercial banks whenever they manage the liquidity, manage the deposit base. And the other important aspect of the banking is basically the capital. And the capital is basically what? The capital means, according to the Basel norms, the capital basically is measure the stability of the banks. The capital is basically measures the stability of the banks. That means if the capital base is strong, then this bank is less prone to liquidation, and the probability of any kind of problem with respect to the bank will be relatively less. So if you go through that particular kind of materials, you will find that the particularly the Basel norms are based upon the stability of the commercial banks. And all those stability are measured through the different kind of capital ratio. So broadly, there are two broad ratios what we can use in terms of the capital. One is your, what we call it, the capital to total assets, total capital divided by total assets. And the total capital means there are two broad components. One is tier 1 capital and another is the tier 2 capital. Tier 1 capital is the core capital, that means it is the equity. And the tier 2 capital is basically the subordinate debts or the bonds. And the total assets already you know. And but the Basel has recommended about a ratio called the capital adequacy ratio. So in the numerator, we have the total capital, and in the denominator, we have the risk-weighted assets. So whatever assets the bank has, to different assets has been given certain weights on the basis of the nature of the risk involved in that. And whenever you talk about the nature of the risk, Basel has basically, there are different Basel norms, Basel 2, Basel 3, Basel, particularly up to Basel 3. So in that context, if you see, previously Basel has given a lot of emphasis on the capital risk, the credit risk. The credit risk is nothing but the default risk. What is the probability of default against that particular type of asset? And the asset, already you know that that is nothing but most of the lending activities or the loans. So in that case, what happens that the weights are basically provided on the basis of the credit risk. And further, there are other kind of risk which has been incorporated, which is also major concern for the banks. Then after credit risk, the next importance was given to basically the concept called the market risk. And the market risk means it is comprised of many risks. One is your interest rate risk. You can any risk with respect to the fluctuations of the other macroeconomic fundamentals, which have the linked with this different kind of assets what the banks are providing. So in that particular process, what happens that if you talk about, let you take the example of interest rate risk. The interest rate risk has two components. One is your price risk, another one is the reinvestment risk. If the interest rate risk has increased, then the price of the bond will go down. That means you are exposed to more price risk. But at the same point of time, whatever coupon payments you will be receiving, that coupons can be reinvested in the market with a higher rate. That's why your return can be increased. So price risk and the reinvestment risk go in the opposite direction. So that is the basic philosophy of the immunization, that already what I was just discussing with you. So in that process, we always try to see that how exactly the price risk can be compensated by the reinvestment risk. But the interest rate risk or market risk, that is a major concern. And the Basel has recommended certain methods to how to calculate this market risk. That let the value at risk is a method what has been recommended to calculate the market risk according to the Basel committee. Then we have another risk they have incorporated of late, that is the operational risk. The operational risk, the source of operational risk are many. Operational risk include legal risk. Operational risk include reputational risk. There are different other kind of unforeseen risk which may arise because of certain issues, certain problems. So these are basically part of the operational risk. Or those operational risks is difficult to quantify, but still Basel has recommended certain methods how to quantify the operational risk. That if you go through that particular material, you will have a broader idea that how the operational risk can be measured as per the Basel norms. Then finally, Basel committee has recommended the liquidity risk. The liquidity risk, which was not considered in the previous Basel committees, that has been included in the latter Basel recommendations or the Basel norms. And liquidity risk, already we have discussed that that is nothing but if you are not able to satisfy the liquidity requirements of the clients or the customers, then the bank is exposed to the liquidity risk. And Basel has recommended certain stable funding ratio and the all kinds of, there are 2-3 ratios which has been used to measure the liquidity risk. And the bank always look at those ratios, and periodically that review process would go on, that how that particular liquidity risk can be managed by the commercial bank. So that is about the liquidity risk what the Basel has recommended. And in the recent recommendations, Basel has made a lot of modifications. There should be a capital conservation buffer. There should be some kind of extra capital the bank has to maintain and to avoid any kind of unforeseen situations. And by that, the stability of the banks can be maintained over a period of time, and there is a less probability of default in the system. And other aspects also we have discussed about the certain off-balance sheet activities. There are certain commitments the banks can make, particularly there are certain guarantees. There are certain kind of loan commitments the banks might have done. But most of the cases you might have observed, those things may not be utilized. So that is the commitment, and the bank charges some commitment fee. But if there is a requirement, then these commitments will be utilized. But there is no such requirement, the commitment will not be utilized. So the cash or the money which is required for fulfilling that commitments, it is not mandatory that commitments is always, or the particular cash or particular amount of resources will be utilized for that. So that's why there are certain off-balance sheet activities we have recognized, and those activities also has the impact on the performance of the banking sector as a whole. In view of this, we have tried to examine certain issues with respect to the off-balance sheet activities. And this off balance sheet and the nature, a source of income from this kind of non-conventional banking activities nowadays has grown up. So we say that the bank is more innovative, the bank is more efficient if their non-interest income is better for the commercial banks. And the non-interest income basically includes these off balance sheet items like your consulting, like your loan commitments, like guarantees, all kinds of things basically include this off balance sheet part. In today's context, in the globalized or the maybe the financially integrated economy, if you see that the banks cannot solely rely upon this conventional banking activities like generating income through the interest only by providing the lending activities or only participating in the market related investment activities. So apart from this, they can go for certain kind of innovative services like this commitments and other things. By that, it will diversify their sources of revenue. And as you know that once these sources of revenues are diversified, then this net income and all these things can be maximized in a better way. And these banks can sustain in a better way for a long period of time. And the probability of liquidation will be relatively less. So this is what about this overview of this particular course, whatever we have discussed in the last 12 week sessions, up to 60 sessions, whatever we have discussed. And hopefully we'll have a clear idea about the different issues. And further, if you have any kind of query or any kind of doubts with respect to any kind of topic, then always you are free to write to us in that particular forum, and we'll also happy to answer that questions. Take care. All the best for your exam. Thank you very much.